Everyone, and welcome to a second Rate Your Portfolio, Rate This Portfolio. We are looking at someone's portfolio. It's a little complex, but I think I understand it. This person has QQQM and ONEQ, so it looks like Wealthfront. Given that they're in Wealthfront typically buys a similar ETF that's less money to make your input when you want to give money more broad, so it could buy more shares. And then it buys tax harvesting when it sells. It has to buy something similar to avoid a ding. So it buys ONEQ when it sells QQQ, and it looks like here there's QQQM, which is a cheaper version of QQQ, but essentially the same. Then they have VTI, which is a total stock, and ITOT for tax loss harvesting purposes, and because again it's cheaper than VTI when you want to buy full shares. Then you have VEA and SCHF, which are international emerging. And you have VWOIEMG, which is international emerging. And those, it looks like they have a very small balance on those. Maybe they have less percentage on those for when they give money to their portfolio. It probably gives money less to those because they have a allocation that is less percentages, which makes sense because you're going to want to more have QQQ, but emerging international have been doing well lately. So maybe you want to increase those. And then VIG and DGRO for their dividend. So let's actually take a look now at each one of those and see what we're looking at. So QQQM, we see that it's Invesco's technology fund mostly. It's more of a growth. It has different funds, but we'll take a look. Most of their holdings are in these top 10. And when I say most, it's very much close to that. It's 49.44% in NVIDIA, Apple, Microsoft, Amazon, Tesla, Meta, Alphabet, Broadcom, and Palantir. And of course, there's about, let's say, 90 more holdings than this in QQQ. And we see that it's mostly made up of technology and communication services. So next, we're going to look at VEA, which is a developmental international market. So we see here, let's check the 1 year. We see the 1 year is at 36%, which is amazing gains, obviously. That beat the S&P. But if we go back to the 1 month, we're at about a 0.32. And the holdings are going to be more international, so not recognized companies typically. We have ASML, Samsung, AstraZeneca. We have Roche, Nestle SA, and these other companies with the Royal Bank of Canada. And we see financial services. So we know that this one's not going to have much of a overlap with QQQ. Next, we're going to take a look at VWO. This is the emerging market. We see a 1 year at 29%. Again, that's amazing. Let's go back to the 1 month. So we see the 1 month we're about a 5%. And then today is up 0.73, which is actually pretty good. That's kind of crazy. So we see here, this is good. This is a Taiwan semiconductor. Semiconductors, if you don't know, are going to probably skyrocket. Don't take my advice or opinion. But semiconductors today have been up tremendously. Actually, TSM just had a very good 35% gain in their total earnings and their net profit. And they just released that on Wednesday of this week. So take a look at that. Take a look at the semiconductors. Elon Musk is anticipating a massive growth in robots, and you need semiconductors for robots. And we see here there's other holdings internationally, and even these don't have any overlap, it looks like, with the other international fund, VEA. So next we have a growth fund, DGRO. This is the tax loss harvesting or cheaper version of VTI. Probably going to be primarily the same. We see here we have Exxon, JP Morgan, Johnson & Johnson, Microsoft, Apple. These companies pay you a dividend for holding on a monthly or quarterly basis, and this is for income. So if you're in a situation where you don't want to have, where you can't contribute to a Roth and you have a traditional IRA, that's all taxable right now. So be careful with how much taxable income you have, especially if you want to avoid being put into a higher tax bracket. Next we have VIG. This is again the more expensive dividend fund that DGRO is paired with. And we see here that it's similar companies, Broadcom, Microsoft, Apple, JP Morgan, Visa, Exxon, Johnson & Johnson, Walmart. Again, this is a dividend fund, so they're going to pay you. Next, we have ITOT. This pairs to VTI as a total stock index. We see here that the 1 year was 16. So you see that the international emergings beat this by a good amount at almost double. So in the 1 month, we're at a 2.3, which is pretty good, honestly, for the 1 month. If you can get that per month, you're up 24% in the year. So we see here the main holdings are NVIDIA, Apple, Microsoft, Amazon, Alphabet, Broadcom. So it looks like ITOT is going to have at least a good chunk of overlap with QQQ in the sense of the main holdings. But of course, VTI holds, I believe, over 500 funds. So ITOT probably has a similar amount. Now we see VTI, and we're going to check the overlap in a second, actually. VTI, the 1 year, is 19%, so it did a little better than ITOT. And we see here the holdings are very similar. Apple, NVIDIA, Microsoft, Amazon, Broadcom, mostly in technology. That's 34%, so that's going to have a little bit of overlap with QQQ, which is okay, because this is actually a total stock. QQQ is more growth heavy. And then we are going to get to the overlap now. I know this is the fun part. So let's check QQQ with VTI. You see there's a 46% overlap by weight. That's actually a lot. But it's a little bit good because 54% of it is not going to be the same. So when there's downturn in technology, which QQQ is heavy in technology, VTI will help you back you up a little bit because it has, VTI has over 5,000 holdings. QQQ has 103. So you see almost every holding in QQQ is in VTI. So you're getting about 3,400 other stocks, which make up about 50% of VTI, not in QQQ. So that is a pretty good overlap by weight. So you may want to just do QQQ if you don't care about risk as much and want heavy growth. You could do like 80% allocation to QQQ and 20% to VTI if those were the only two you were in. So now if we pair with ITOT, I'm pretty sure it's going to be very similar. You see, almost similar. It looks like it has one more holding, but it's virtually identical. So now if you have this with the international, it's going to be very minimum. See, only one holding, and it says 0%. So QQQ paired with a emerging is no overlap. So this is a good comparison to have. Then if we pair it with VEA, which is another international, we see there's a 1% overlap, so that's really good. That's what we want to look for. Now if we do that with, let's do one more. Let's do QQQ with the dividend fund, which will probably be, I'm guessing, less than 20% overlap. Almost 28% overlap. That's good. This is a good pair to have with QQQ to have with the dividend fund. But now if we start doing the international funds together, like VWO with VEA, we see that there's no overlap, which is really good because both are international. So if we scroll down, you see that the holdings are not overlapped at all, and you're getting good international and emerging market diversification. So these are actually really good to pair together. You would have done extremely well had you had both of these at a high percent. You would have earned roughly 20% each for these. And now if we do the VIG, no overlap. So dividend fund is good to have with VEA, and I'm assuming no overlap with VWO. No overlap with VWO. So overall, let's go back to what funds they had. Give me 1 second. Let's go there now. Boom, boom, bump. So we're here now in the Rate This Portfolio main page. So overall, I think this is a pretty good portfolio. I'll give it like a B minus, maybe even a C plus, only because it does have a lot of things going on. I think they could change this by doing just QQQM. I'm not sure there's a way to do that. And VTI and ITOT, I'm wondering if there's a way just to select ITOT rather than having both, because it's a little silly to have both of them, especially when you have only, like, was it 8 shares of VTI versus ITOT. It looks like this is a relatively new fund for them, maybe a few years, depending on how much they're contributing. They're on a good track. It looks like they have about 20,000 in here based off of these numbers. And I would recommend increasing your contributions to VWO and IEMG. It looks like you have almost no shares. Knowing how Wealthfront works, it looks like Wealthfront. Knowing how Wealthfront works, you probably have a very small allocation to that. I would decrease your allocation to the stocks. It looks like you have a very high allocation to that, and increase by at least 5% to VWO and IMEG and VIG and DGRO. and the VEA and SCHF. It looks like you have VIG and DGRO at like a 20% because you have a lot of that. So definitely increase your contribution to VWO and IEMG and VEA and SCHF if you want a more balanced portfolio, because you don't really have much in there. So this is basically like nothing. It's like $500. So I rate this portfolio a C plus after knowing that. If you do what I recommended, although it's not financial advice, that's personally what I would do if I had these funds, then I think this would be a more B to A portfolio. Overall, awesome. Thank you for submitting this, and it is anonymous, so if you want to submit yours, please go ahead and do so. Have a great day.